Welcome back, everyone. Michael here with Offshore Citizen. We are here in beautiful Maldives, and I'm going to talk to you today a little bit about kind of an obscure little tax benefit between Canada and the US. So, to be fair, this doesn't apply to that many people, but I think it is an interesting thing to understand, and this sort of concept can apply to people in many situations. So, even if this specific one doesn't apply to you, there might be a series of other ones related to this that apply to you, and so it can help you with thinking about some of these concepts as we go forward. So let's dive in and talk about that right now. Now, if you're new here, welcome. I'm Michael. I and our team at Offshore Citizen are some of the foremost tax and international relocation specialists in the world. And so hence we're talking about topics of tax. Lots of people out there kind of, might sell companies or something, but they don't really have deep tax expertise, in particular across multiple countries. We work with clients from 145, I counted the other day, 145 countries and territories that we have dealt with, and dealing with relocations to all different parts of the world, different corporate structures, solutions in different countries, banking in probably dozens of different jurisdictions, etc. And so if those things are helpful to you, you'd like to optimize your global tax, you'd like to relocate, you'd like to become a digital nomad, you'd like to any of these sorts of things, and figure out how to do that, please reach out to us. You can book a call with me, calendar.com/Michael-Rosmer, link in the description below, or send a message through offshorecitizen.net. Okay, so let's get into some obscure tax facts that you kind of have to geek out on tax, like I have done over various years, in order to sort of get into some of these nuances. And tax can be, to be fair, somewhat of a pain, but on the other hand, it can be quite fun to try and figure out these puzzles, etc. I have one of the members of our team she's one of our key people who works with clients on helping to do various different planning and implementation, and she and I will talk about how it's kind of like figuring out a puzzle, which is quite fun. So here is the setup, okay? You are in the US, okay? So you're an American, or at least a US person, meaning that you might be a US green card holder, a US resident, or a US citizen. You hold a bunch of shares. Now, what is going to happen if you sell those shares? Well, you're gonna get taxed on those shares, right? And you'll be taxed based on the adjusted cost basis between the rate at which you purchased those shares and the rate at which you sell those shares, okay? Very cool. Now, the thing is, what would happen if you were to gift those shares to somebody else is, okay, there's gift consequences in the sense that there's a lifetime gifting limit that you have, but provided you were within that gifting limit, the person who was receiving those shares would inherit your cost basis, and therefore, when they sold the shares, they would pay the taxes. So let's just use a simple example. Say you bought shares of Apple for $50 a share, and let's just say they had gone up to $200 a share. You took those shares, you gave them to somebody else. Let's say that say you're in, Nevada, and you've got a friend or relative in Texas. You decide, hey, I'm gonna gift you my shares, right? Rather than gifting you cash, which I'm gonna have to pay tax on, I'm gonna gift these to you. And so you receive them. And so you don't pay any tax at the time you receive, and the person gifting and the person receiving, neither of them pay tax at the time that this happens, okay? That would be the normal setup. But then what will happen is the cost basis of the person who is gifting will pass to the person who's receiving. So the fact that the person gifting had bought them for $50 a share will basically make it effectively the person who's receiving has a $50 a share cost basis. And so let's say they then go up to $250 a share and the person who received sells them. They're gonna pay tax on the $200 of gain above the $50, okay? And that'll be taxed probably at a long-term capital gains rate, which is gonna be applicable to whatever tax bracket you're in for long-term capital gains, okay? That's how that would work. However, here's the really interesting thing in the US tax system, and this is a very unusual point, it's kind of a bizarre way to go, is if you were to gift those to a foreigner, then the foreigner, yes, would inherit the tax base, the cost basis, but interestingly, the foreigner would not necessarily be taxable in the US on that. Typically they would not. So you're like, okay, well this is interesting, right? Because let's say the person you're gifting to, instead of being somebody in Texas, is let's say an Irish resident and citizen, right? What's gonna happen there? From a US standpoint, when they sell, they won't pay any US tax. Now, they'll have to deal with Irish tax though. Where this can become quite interesting is, let's say you're doing this between Canada and the US. So you have a mismatch. And this is one of the things that hybrid mismatches, or general tax mismatches, are deeply misunderstood. I have to kind of argue and explain this to accountants and lawyers and tax advisors, etc., who are specialized in their particular area quite often. So for example, a common one that I've talked about is a US LLC is treated, that's treated in the US as a disregarded entity, may not be treated as a disregarded entity in the receiving country. This is also the case between Canada and the US. So although in the US, the income of a US LLC passes straight through to the single member holder of that, and therefore the individual is taxable on it. In Canada, they treat a US LLC as a limited company, and therefore, unless there's a distribution explicitly made, there is no distribution, and therefore no tax, although there might be tax under foreign accrual property income, or the company itself might be taxed, but the company is viewed as a separate legal person for Canadian purposes, which is not true in the US side, okay? And so it's really important when you're doing international tax planning to understand both sides of the border. That's like a very, very key thing, because what might be good on one side and what might be good on another side could be completely different. In fact, this is how I originally got into this business, etc. Was I was doing tax planning for myself, for my own business and investments between countries, and I was running into these issues where people didn't understand both sides, and therefore I had to figure it out and deal with lawyers who could understand, etc. And anyway, that's like long story. But the point is, both sides are important, and both sides can screw you. It can be really bad, right? So for example, the very famous one is that if you're an American living in the US and you own US property, it would be really common to hold it in an LLC. And therefore a US accountant or lawyer may advise somebody in Canada, oh, you're buying some real estate, hold it in an LLC. Well, it turns out for Canada, this is a really bad idea. And there's a bunch of reasons for this related to the fact that for a Canadian purpose, that is a separate legal entity, and it has to do with carrying forward losses and a bunch of other stuff that you're just basically not able to do in the same regard. And so hence the legal structure for somebody from Canada investing into the US is different than what an American should use investing into the US. And if you don't understand both sides, you won't understand that, okay? So anyway, let's go back to this example of the gifting, which is really cool. So what happens? Well, in Canada, the opposite sort of is supposed to take place, okay? So what would normally happen in Canada is if I go and I'm gifting, then I'm typically going to pay the tax. It's going to be almost like a deemed sale, right, at the time that I'm doing this gifting. And so the cost basis will be, the person who's receiving it will inherit the cost basis at the time that the asset is received. So notice this difference. Normally what would happen from an American perspective, the cost basis that's inherited is the purchase cost basis, whereas in Canada, the inherited cost basis is the cost basis at the time that it was received. It's as though it was purchased by the person who receives the gift. What does this mean? Well, let's just say, for instance, this would be like a loophole that I guess you could get away with, although, under disclosure, they may not like it. But by the book, you could basically have this thing where let's say that one spouse is in the US and one spouse is in Canada. And the spouse in the US has a bunch of US shares that they bought at one price. The price goes up. They could then gift those to their spouse in Canada. The spouse in Canada could receive them and they could sell them without paying any tax on it. And then the couple could have, this extra bunch of money. Now, a whole bunch of reasons why that might not play out in practice, because you're probably living together and all sorts of stuff like that. But it's an interesting example of how you can do some really unique tax planning once you start getting involved in cross-border things that you cannot do when you're dealing domestically, and how the differences from one side to the other can apply. So this thing I'm mentioning in the case of the US, which I was shocked, like when we were going through doing research on gift tax consequences in the US and gifting shares and gifting them to foreigners, when we came out, I was just like, this cannot be the case. This is crazy. They're like just giving away that? It's like, yeah, they are. Wow. So yeah, I mean, you could do the same thing, for example, if you were to gift to somebody in UAE, right? UAE, they don't have taxes. There's a bunch of countries where essentially you would either inherit the cost basis at the time that you receive the gift, or you would not have taxes, period. And therefore you could get this sort of quite advantageous structure. Now, here I'm applying this to the US. And so, not all places are like the US, right? In a lot of places, when you're gifting, you're going to be paying tax on it. In a bunch of places, when you receive gifts, you're going to pay taxes on them. But the same principle of thinking can be applied to many, many situations around the world. Now we're talking about gifting, but I did mention previously US LLCs. And the reality is there are many, many, many examples like this around the world that if you're paying attention to, you can take advantage of some nice little tax planning that might save you a whole heck of a lot of money. So anyway, if you're interested in these types of subjects, hey, follow our videos, check them out, but also reach out to us related to you, and we're happy to help you. We will see you on the next video.